Okay. Since I'm the only person, I guess I should reach. Should I please?
Yeah,
I'm asking if I should read the question.
you are the only one here. Oh. But
Yes.
don't worry.
On
Last time, I thought only uh I thought only I thought only one person in FM class, so that will not be a problem. Since the recording will be there, they can come and listen at any time. So read the question for us. Let's move on.
okay. On 1 January 2015, Alista acquired 75% of
All right. So the
Tesla's
first thing that you
equity
have to
shares.
do, if you go to the exam that you see console question, the first thing is just read the requirements. What are they asking you to do? What is the requirements?
Okay. Prepare the consolidated statement of financial position for Alista Group as at 30th June
The date is very
2015.
important. The date is very important. The date will tell you how to treat some of the items. So the date is very important. That is 30th June. So that means their financial year starts from when?
30th June, July.
It started from July to June, isn't it? Every year.
Yes,
All right.
yes.
So the first thing that you are going to do is they are asking you to prepare a statement of financial position. So the easiest way is that just go and put your, you know that some of the figures over here, you won't do anything to them. So just go and do your statement of financial position. Just go and put your statement of financial position there. Then you add some of the items. So it is Pallister Group. Pallister Group. Okay.
Yes.
So you put Pallister Group at the top there. Then you come to consolidated statement of financial position. As at 30th June. As at 30th June 2015, right?
Yes, sir.
Okay. So what you do is that you come and put your assets here. So let's look at how the question grouped the assets. Okay, they do it non-current and current. So you also have to do it like that.
Okay.
So you have the assets. Then you have the non-current assets. And the currency sign, if you like, put it here. I hope they are keeping 3 zeros. Okay, they are keeping 3 zeros at the top. So if you like, you can also do the same thing.
Okay.
So for the current asset, then we have property, plant, and equipment, isn't it?
Yes, sir.
Okay. So you put it in the bracket. You are preparing consolidated statement of financial position. So you pick that of the subsidiary and also the parent. So the parent is 55,000. The parent is 55,000. Then you add the subsidiary's own, which is
600.
28,600. So you add the 2,600 to it. Then you don't know what is going to happen. So you are just picking the figure. So the next item that you just do like that. If anything, then you come and add or subtract there. The next one is financial assets. Financial assets. So for the financial assets, you pick the figures also one by one. Okay. The first one is what? 11,500. Then you add.
Dylan said that's the financial asset equity investment is we don't show it on the face of the
We don't do what?
consolidated. We don't show the investment.
No, this is financial asset is different from the investment itself. The
Okay.
financial assets is the parent is having other instrument that they are carrying using financial instruments. But if it is the investment, they will say investment in subsidiary or investment in associate. The question will tell you. So this financial asset is different from the investment that they are making in the subsidiary.
Okay.
Are we on the same path?
Yes, sir.
Okay. So this investment is different from the normal investments. It's different from. It's just like you have acquired a company, but you still have investment. You still have shares in other companies. You still have shares in other companies, which is less than 20%. So you carry that particular investment using the financial instrument, which is the IFRS 9. So that one is different. If it is an investment in associate or subsidiary, the question would specifically state that. Are you okay?
Okay.
All
Yes,
right.
sir.
So the next one is the
And
6,000.
then please, on investment,
All right.
is it possible that just as this one, they could have stated financial asset equity investment, the total,
Okay.
then then in brackets, maybe state the amount which they invested in the subsidiary.
Yes.
So
Yes.
meaning there's going to be a difference, maybe other
Yes.
investments in other companies. So should we
Yes.
also look at that?
Yeah. It can also be possible. With that one, they will just give you the title investment. So you have to reconcile the investments. So you have to look at the consideration that the parent is paying for the subsidiary. So you do your consideration, the amount that they pay for the subsidiary, then you compare with the investment that you have there. If it is the same, then it means it is entirely the investment in the subsidiary. But if there is a figure there, then it means that there is other investment in other companies, which is the financial asset that we are looking at this part. So always, if you are not giving, you are just giving investments. But I said it last, that if you are just giving investment, try to reconcile the investment with the amount that you are paying for the subsidiary or the investment that you are doing in the associate. Add them and compare with the investment figure over there. If it is not the same, then there might be other investments.
Okay.
So the difference will be the other investment that you are going to put there, other investments. All right.
Okay.
Can we move on?
Yes, sir.
All right. So these are the items that we have. Leave like maybe 4 spaces. Other things will come. So just leave like 4 spaces. Then we have current. We have current assets. This is before you start workings. Do these things before you even start the workings. So the current assets. The first one is inventory. The first one is inventory. Can you write the figures down so that you give them to me? 17,000, 15,400. Okay. So inventory is 17,000 plus 15,400. The next one is trade receivables. Trade receivable is how much?
I couldn't write it. Okay.
14,000 and
14,300
10,500.
and 10,500.
Right. Yakubu, we are solving question 1. Okay, and 10,500, isn't it?
Yes, sir.
The next one is what? Bank. So bank, you pick the figures there.
2,200 plus 1,600.
2,400. 2,400 and what?
1,600.
Okay. So this one you can go to equity and liabilities. Just reproduce what they have given to you. Just put that they are going to mark them. So just have your equity and liabilities. Equity and liabilities. So we start with equity first. So the first equity over there is what? The first is equity shares, isn't it? At 1 cedi each. Equity shares at 1 cedi each. We don't show the equity shares for the subsidiary because it's going to cancel the investment. So we show only for the parents. How much is for the parent?
20,000.
20,000. So we move on to the next one. What is the next item there? Other component of what? Equity.
Okay.
Other components of equity. We show only the parent own. So we leave it like that. We go and do workings for it and see whether there is other items that will increase that one. If you come to retain earnings to we do working for it, which will be the group retain earnings. So group retain earnings. So you leave that one to you. Then let's go to, after all these things, then you have non-controlling interest, the portion that is not controlled by the parents. No controlling interest. That one to we do workings for it. Then the next one will be liabilities. Let's look at the liabilities that we have. Okay, we have only current liabilities. There's no non-current liabilities, but you can still leave space. If you have any non-current liability, you bring it there. So what are the figures for the current liabilities?
25,800.
25,800. And what?
18,100.
18,100. Okay. Okay. So after doing this, then you now think about your workings. So I'll use different sheet for the workings. So let's come to our workings. So the workings, the first thing that we have to do is what? The first working is what?
The structure.
Which structure?
It was given in the question.
You still have to show it.
Okay.
So the parents, the NCR, isn't it?
Yes.
Okay. So let me show the percentage here. So the parents in the NCI. So let's go to the question. Let's go to the question and see what they are saying there. Okay, so let's come to the question now. On 1 January 2015, Pallister acquired 75% of Stretcher's equity shares by means of an immediate share exchange of 2 shares in Pallister for 5 shares in what? Stretcher. So it means that the shareholders of Stretcher should bring 5 of their old shares and take what?
1.
And take 2 new in what? The Pallister, which is the parent, isn't it? All right. But let's look at the reporting date. What is the reporting date here? The reporting date is what? 30th June 20 what?
15.
15. So it means that what is the post-acquisition period?
6 months.
It's 6 months, isn't it? All right. Let's move on. Let's move on. Okay, so right now we can go and put our group structure there. 75% against what? 25. Then you can total it and put your 100 there. And put your 100 here. That is all. Then the next one is the what? Acquisition date, isn't it? You show the acquisition date. What is the acquisition date?
1st January.
1st January 2015.
January.
Okay. So you have January 1. 2015. What is the reporting date?
30th
30th what?
June 2015.
June. So June 2015. What is the post-acquisition period?
6 months.
Okay. Post-acquisition period. This is going to take 6. So even if you don't know anything, do this in the exam hall. 6 months. All right. Okay. The next one is the what? The net asset, isn't it? So you show your net assets. Net assets. Your net assets. You show at acquisition and also
But
you show acquisition and also reporting. Okay. So after this one, we have the, okay, let me show it here. Let me put the 3 here. After this one, we have the 3. The 3 is what? Goodwill calculation, isn't it?
Yes, please.
Goodwill calculation. So the goodwill calculation, we start with our purchase consideration. So we start with our purchase consideration. How much are we paying? And how much should we have paid? The difference is the goodwill. Okay. So let's come and read the question now and start putting some things there. Okay, let me put the non-controlling interest also here in the group return earnings. Okay, let me put 4 non-controlling interest. So that anytime that we get something on them, we just come and put them there. Non-controlling interest. Let me come and put the group return earnings here, which is 5. Group return earnings. All right, so let's go to the question now. Okay, let's go to the question now. So who is reading for us? Kathy, read for us. You know you are the only one who has a nice voice here.
So, in addition to the okay, so, the fair value of Pallister and Stretcher's shares on 1st January 2015 were 4 cedis and 3 cedis respectively.
Okay, so let's look at, so how was the consideration settled? First was share exchange, isn't it?
Yes.
So the question is, they are buying 75% shares of what? Stretcher, isn't it? So the question is, what was the total shares for Stretcher? Stretcher is what? What is their share value?
1 cedi.
1 cedi. So what is the total value of the
20,000.
shares?
20,000.
20,000. 1 share is what?
1 cedi.
1 cedi. So it means that they are going to have 20,000 shares over there, which is 20 million, because they are keeping 3 zeros at the top, isn't it?
Yes.
All right. So if you are buying 75% of that, 75% of 20 million shares, what would be the value of the shares that they are buying?
15,000.
That would be 15 million, isn't it? That would be 0.75 times what? 20 million. That will give us 15 million, isn't it? All right.
Yes.
So they are buying 15 million shares. All right. Now the question is saying that the consideration, there was a means of what? Share exchange. The share exchange, what they are saying is that we don't have money to give to the shareholders of Stretcher. So what will happen is that we are going to accept them to be part of the owners of the parent company. But how was this done? we are giving them 2 shares for every of their 5 shares that they hold over there. So you are going to bring 5 of your shares and come and take 2 new. And their shares is 15 million, isn't it? Their shares is 15 million. So how many 5 shares can they bring from the 15 million? How many shares can they bring from the 15 million? How are you going to do that? How are we going to do that? Bring 5 of your old shares and come and take 2. So first, what you are going to do is that divide the number of shares by the one that they are bringing. So 15 divided by what? 5. What are you getting?
3,000.
You are going to get 3 million, isn't it?
Yeah.
All right. And this 3 million, they will bring you to take 2 shares each, isn't it? Then you multiply by 2. So to be at the safer side, what we do is that we use 2 over 5 times the number of shares that we are buying. So do 2 over 5 times the number of shares that we are buying. What are you getting?
57.5 million.
We are getting what?
57.5 million.
60 what?
You said
2 over 5 times the number of shares that we are buying. It is the number of shares that they will bring to take to the company, not the total number of shares. We are buying only 15 million. So those who are owing the 15 million will be the owners of the company, not the entire 20 million. So
6,000.
2 over 5 times 15 million is what?
6 million.
Is 6 million, isn't it?
6 million.
So they will
Yeah.
now come and take what? 6 million. They will come and take 6 million. They will now have, instead of them having their 15 million, they will now be having what? 6 million shares in our company. That is the number of shares, isn't it?
Yes.
So what value are we going to place on the shares now? Then we go to the question and look for the shares of the share value of the parents. The share value of the parents. What is the share value of the parents?
4 cities.
4 cities. So this 6 million that you have in the parents now will be valued at what? 4 million. So value that, let's see. 6 times 4 is what?
24 million.
20.
4 million.
So the share exchange is 24 million. What will happen to the share value of the parents? Is it going to increase? The parent is having what? The parent is having 20 million shares in issue, isn't it?
Yeah.
The share value of the parent is what? 20. That is for the existing shareholders. Now they are issuing shares to new shareholders, which is the shareholders of the subsidiary. What will happen to the equity shares of the parents? Is it going to be 20 at reporting or it will increase? I want to hear.
Oh, they say
Is it going to increase?
Yes, it's going to.
Who will be the shareholders of the parents now? It will be the old people plus the people coming from the subsidiary, isn't it? What is the value of the old people? What is the value of their shares? The old people, what is the value of their shares in the parents? It's 20 million, isn't it? We are 9 here. We are 9 here. So what is the value of the old shares of the parents?
20 million.
20 million, isn't it?
Yeah.
That is for the existing shareholders. But now they are accepting new shareholders from subsidiary. So who will be the owners of the company now? The existing plus those coming from the subsidiary, isn't it? The existing shareholders are having 20 million. The people from the subsidiary are having what? 24 million, isn't it? So what will be the total value of the equity shares of the parents now? All right. If you don't know, the share exchange is going to increase the shares of the parents. That is additional shares. So the owners will now be the existing plus the subsidiary shareholders. So whenever there is a share exchange, come and add the value to the parent shares. It is the parent that is issuing the shares. We assume that you are issuing a new share that people are buying. So if you are issuing a new share, the share is going to increase. All right. So we are done with the first part. That is the share exchange. What's next? Let's move on.
Calista will make a cash payment of 1.32
In addition,
per
read from the in addition.
what's the in addition?
In addition to,
Yes,
in addition to the share exchange,
okay, in addition to share exchange, Calista will make a cash payment of 1.32 per acquired share,
okay,
deferred until 1st January 2016.
okay. When was the acquisition done?
Calista has not
When was the acquisition done?
was done on the
1st January 2015.
And when are they
January
paying?
20.
When are they paying this particular money? How many years
1st
time are they going to
January
pay the money?
2016. A year
1 year.
after.
1 year. So that
Yes,
particular money that they are going to
a
pay
year
is called
after.
what?
Deferred consideration.
Deferred what? Consideration. So what is the total value that they are going to pay? They are going to pay. They are saying 1 cedi 32 pesos per share acquired, isn't it?
Yeah.
How many shares were acquired by the Polystar? How many shares were acquired by Polystar?
15 million.
So 15 times what?
1.3.
Okay, what is the value there? So for us to know the value,
19.8 million.
okay, for us to know the value of that one, we multiply the value per share times the number of shares acquired. That would be 19,800, isn't it? When are
Yes,
they
it is.
paying that? When are they paying that? In a 1 year?
1st January. Yeah.
Okay, but it is today that we are doing a consolidation. We want to know the consideration that they are going to pay at the date of acquisition, which is 1 year, which is today. But the money will be paid 1 year from now, isn't it? So what we normally do is that we present value the consideration. How do we present value that? It is the future value over the discounts or the cost of capital of the parents. Maybe the cost of capital, you can do it. Maybe if it is the money will be paid in 2 years time, you do exponent 2. So what we do is that is the future value over 1 plus r or exponent n. The same as how we find future value in FM. So if you want to find the present value of that, the present value is equal to the future value all divided by into brackets 1 plus r, 1 plus r, or exponent n. The n is the number of years. So in that case, what is the number of years there? What will be the number of years?
1.
1. So the present value is equal to 19,800, isn't it? Divided by, what is the cost of capital of the parent? 1.1. It is 10%, isn't it? So
Yes.
the 10% is 0.1. You add it to 1, it will be 1.1. What answer are you getting there?
Sir, please, what are you doing?
What am I doing? I'm trying to find the present value of the future value, because we want to know the value that they'll pay today. So we present value
Okay.
the consideration. So the present value is calculated as the future value. That is the amount that you are paying in the future divided by 1 plus r. The r is the cost of capital for the parents, or exponent n. But in this one, the number of years that they are going to pay the money is what? 1 year. So the n over there is 1. So what you are going to do is that the 19,800 divided by 1.1. What are we getting? What are we
18
getting?
million.
18 million. Okay.
Million.
So let me do something here. And you have a 1.32 times what? The 15,000, isn't it? Or divided by 1.1. So what are we getting? We are getting 18 million. But how much are they going to pay in the future? How much are they paying in the 1 year's time?
80 million.
No,
19,800.
they are paying 19,000 what?
800.
800. But if they should pay the money today, it's supposed to be 18 million. But they are paying 19,800. What is the difference?
1,800.
1,800. It means that they are going to pay interest of what? 1,800 for not paying the money today. So that interest, is it expense to the parents or is a gain to the parents?
It's an expense to the parents.
It's an expense to the parents. But this money will be paying how many years' time?
1 year.
1 year. So what? How many years are we using? We are preparing the account for how many months?
6 months.
6 months. So if 1,800 is 1 year, 6 months will be what? If
900.
1,800 is 6 months, then
1 year.
6 months will be what?
900 cities.
900. So then this 900 is a finance cost for the parents. Is the interest that we call finance cost. So the parent is going to pay this expense. That is why we put it in the return earnings. It is an expense to them, which is supposed to be subtracted from the profit, but the profit is contained in their return earnings. That is why we are subtracting it from that place. All right. Let's look at the next one. What are they saying again?
The summarized statement of financial position of the two companies are as at 30th.
No, let's look at the last part before we come there. Polyester has not recorded any of the consideration for Treasurer in its financial statements. Polyester cost of capital is this. So Polyester has not recognized any of this. The share exchange, they have not recognized it. That is why we added the shares to their equity shares. But if the question should say that they have recognized this, then you are going to see investment under the non-current assets. It is because they have not recognized that. That is why we don't have investment under the non-current assets. Mostly we should have investment in associate, investment in stretcher, then they will put a figure there. But since they have not recognized any of this, that is why we don't have we don't have investment under the non-current assets. So what we have to do is that we have to now do the right thing for them. So we have done the share exchange. We have done the share exchange for them. But the deferred consideration, is it a liability to the parents? The deferred consideration, is it a liability to the parents?
Yes.
Okay. It is a liability, isn't it?
Yes.
But as at the day that they are buying the subsidiary, the liability was what? 18,000, isn't it?
Yes.
But
Yeah.
6 months, what happens? They are going to pay interest of what?
900.
6 months. After 6 months, they are going to pay interest of 900, isn't it?
Yes.
So what will be the total liability for them now?
Be
18,900.
18,900. So you put non-current liability here, then you put the deferred consideration under it. Non-current liabilities, because this will be paid in. If you like, you can also do it current liability because it will pay 6 months from now. It will pay 6 months from now. So deferred consideration of what? 18,000 what? 900.
900.
We can go ahead and put the 18,009. So deferred consideration will always be a liability because you are going to pay the people. You are owing the people. So their money is with you. So deferred consideration will always be what? A liability. Let's move on. Okay. The share exchange, use the proportion given to you, 2 for 5. Then just say 2/5 times the number of shares that the parent is acquiring. If it is 145, it is 1/5 times the number of shares that you are acquiring. Then you now use the value of the parent because it is the parent that is giving them the shares. So the shares must be valued using the parent's share value at the date of the acquisition. That is what we normally do. The deferred consideration, find it and present value it because we want to know the value we should have paid today. So we present value that particular one. Let's move on to the additional information. But before that, let's go to the net assets. The net asset, we take the equity capital of the subsidiary, which is the net asset. Then we have the share capital here, or the equity shares. The assumption is that there is no additional issue of shares during the year. So at reporting will be the same as what? At acquisition, isn't it? The next one is what?
Yes.
Retain what? Earnings. Okay. So let's read the question now to know the retained earnings for the subsidiary. So what was the retained earnings for the subsidiary at the date of the financial year, at the beginning of the financial year, which is July 2014? That is the starting of the financial year. What was the?
14.
It was what? 14,000.
14,000.
Okay. When did we acquire them?
1st January 2015.
So it means that they have done 6 months already, isn't it?
Yes.
So that 6 months, they are going to make profit. The only thing that increase the profit is the only thing that increase the retained earnings is profits. So that means at the beginning of the year, they have 14,000, but they have done 6 months before we acquire them. So it means that their retained earnings will be the one at reporting plus the profit made before we acquire them. So you can see that they have given you retained earnings for the year. This is profit for the year. This is profit for the year. If no question, no other question or no other information is given about the profit made for the year, what we do is that you should just divide this by 6 because this is for 12 months. So we divide this by 2, rather, not 6. We divide this by 2, then we get 5,000. It means that they made a profit of 5,000 before we acquired them. Then we add it to the retained earnings at beginning. And that will be the total retained earnings at the date of acquisition. But let's see whether they say something about that particular thing over there. Let's look at additional information 1. What are they saying there?
Structured business is seasonal, and
Okay.
60% of its annual profit is made in the period 1st January to 30th June each year.
So what are they trying to say? It means that 60% of the profit was for post-acquisition period, which is January to June, isn't it?
Yeah.
So what will be the profit from July to December? What will be the proportion of the profit from July to December? What percentage?
40%.
So find a 40% of their total profit for the year. What are you getting?
4,000.
4,000, isn't it? So what will be their total retained earnings at the date of acquisition, which is January 1? What will be their total retained earnings now?
The total return is
What will be their total retained earnings?
20,000.
No.
10,000.
It's what? It's what?
18.
18,000. It is the retained earnings at the beginning plus the profit during that period, which is 6 months, which is 40% of the 10,000. That will give you
Okay.
18 what? 1,000. Are we okay there?
Yes.
Okay. What will be the retained earnings at reporting? What will be the
20.
retained earnings at reporting?
20,000.
No.
Oh,
It will be the retained earnings at the beginning plus the total
14,000.
profit. It is 24,000. At reporting will be the retained earnings at the beginning plus the profit for the year. That is the reporting that we do. Are you okay?
yeah.
All right. So That will be 24,000. And even if you subtract, you can see that the profit for the year is what 6,000, which is 18 against this one. The only thing is, let's come and see whether we have any other component of the equity there. Do you have any other component of the equity there? Other component of equity, the subsidiary is not having any, isn't it? So let's come to additional information 2. Additional information 2, let's come there.
At the date of acquisition, the fair value of Stretcher's net assets were equal to their carrying amount with the following exceptions. An item of plant had a fair value of 2 million below its current value.
What is the meaning? Let's stop with the first one. What is the meaning of that? So they are saying that in the property, plant, and equipment over there, there is an item that is what? That its actual value is, maybe if they are carrying it as 20,000, the actual value should be what? 18,000. Is that not what they are saying? The fair value is 20,000 below the carrying what? Value. So if the carrying value is 20,000, it means that the fair value is what? 18,000. That is the meaning. Are you okay?
Yes.
So what do we do to now bring the value to 18,000?
Right.
We subtract
2,000.
We subtract 2,000, isn't it? All right.
Yes.
So if you subtract the 2,000, what will be the effect on the net assets?
That means it has impaired.
No. What will be
The
the
val-
value on the net asset if you are doing your total liabilities subtracting from assets? The asset has now, the original asset has now reduced by 20,000. It means that the net assets, which is the shareholders fund, will also reduce by what?
Okay, yes.
The 20,000. That means the new value will now reduce by 20,000. So what we are going to do is that we come and do fair value adjustments here. Fair value adjustment. Since this thing is going to reduce by 2,000, it means that the net asset, the new net asset will now reduce by what? 2,000. The reporting will also reduce by what? 2,000. Because we pick, it is these figures that we are topping up to get a reporting. So it means that if the acquisition is reducing, reporting will also reduce. So what will happen to the asset figure? We have to go and bring it down to the 18,000. So we go and subtract what? 2,000 from our PP, isn't it?
Yes.
If it down, that is this one. Let's look at any other information that they are saying about that. If it should be an increase, what will happen?
Would have added.
We add it to the assets and also add it to the what? The net asset table. Are we okay?
Yes.
All right. Let's come to this side. At the date of acquisition. Okay.
Please scroll up a bit, sorry.
Okay. At the date of acquisition, what happened?
The fair value of Stretcher's net assets was equal to their carrying amount.
Okay.
With the following exceptions.
Okay.
An item of plant had a fair value of 2 million below its current value.
Okay.
At the date of acquisition, it had a remaining life of 2 years.
Okay. Okay. So the asset that they are saying that has the value, this one. So let's assume that this thing is the actual value, the original value is what? 5,000, isn't it? Now the new value will be 3,000 because the fair value is 2,000 below the carrying value, isn't it? So if we are using 2 years, but when was the acquisition done? It was 6 months, isn't it? What would be the depreciation if you are using the old value? What would be the depreciation if you are using the old value?
That would have been 1,005.
If you're using the old value is 5,000. What would be the depreciation? It will be 5,000 divided by 2, isn't it?
Yes.
Multiplied by what?
6 months.
6 months. Because the acquisition was done on 6 months, and this fair value was done at the beginning of January. January to June is 6 months. So if you have 5,000 divided by 2, it is 2,500. 6 months is how much? It will be 1,250.
Hello,
isn't it?
sir.
Yeah,
Yeah, 1,250.
1,250. But if you're using a new value, that is the old depreciation that you charge to statement of profit or loss account because you are not aware of the fair value adjustment. All right. If you're using the new value, what will be the value there? What should have been the depreciation if you're using the 3,000?
750.
That would be 7 what?
50.
50. So what have you done?
Depreciation has decreased.
No, it means that you have overcharged the depreciation by 500, isn't it?
Okay.
If you are the value has
Sir,
reduced.
please,
Yeah.
my question. Sir, please, can I go on?
Yeah, you can go ahead.
The fair value.
Okay.
An item of plant had a fair value of 2 million below its carrying amount.
Okay.
I was thinking what was declared during the agreement period. If it is 5,000, they quoted maybe 2. So they need to add the difference so that it will be the same.
That is not the meaning. That is an English word, and that is mathematics. It's a mathematics English. It's not for ladies that are good in English. All right. I will take that particular statement for you again.
Okay.
An item of plant had a fair value of 2 million below its carrying value. So it means that the carrying value is 2 million higher than the fair value. That's what you are saying. You are having an amount, or they are sharing money, and you are having 2 million below the amount that your sister have gotten. It means that if your sister have gotten 4 million, you are going to get 2 million. That is the meaning. So it means that the fair value is less than the carrying value. That is what they are saying. Or the carrying value is higher than the fair value. That is what they are saying. So if the company is saying that the plant is 5,000, the actual figure should have been 3,000.
Okay.
Which is a fair value. So the fair value is 2,000 below the carrying value. So the carrying value is higher than the fair value. That's what they are saying. Are you okay?
Okay.
All right.
All right.
So 5,000 is the carrying value. You are charging a depreciation of 1,250. And this one, if it is the new value, which is the fair value, the depreciation will be what? 750. So it means that you have overcharged your depreciation by what? 500. What I'm trying to tell you over here is that whenever the fair value is lower than the carrying amount, it means that the company was charging the depreciation on the original value. In that case, there will be an over depreciation. So what you do is that there was a depreciation relating to the fair value reduction. So it means that the company has charged depreciation to the 2,000 also. The reduction, they have charged depreciation on it. So we just have to come and look at what depreciation was charged on the 2 million, which is the 2,000 at the date of acquisition. That will be 2,000 over what? 2 times 0.5, because this is 6 months. What will be the answer there? 2,000 divided by 2 times 0.5. What is the answer there?
500.
500. So you can see that what I did first, the difference was 500, isn't it?
Yeah.
But you can't go to the exam and be quoting figures from your head. Just take the 2,000. It means that if the company should have been aware of the 2,000 reduction, they won't charge the depreciation relating to the 2,000. So it means that they have charged the depreciation on the 2,000 too. Let's find the portion of depreciation charge on the 2,000 and go and do what it has done first. The 500 was subtracted from profit, isn't it? The 500 was subtracted from profit, isn't it?
Yes.
So it shouldn't have been subtracted. So what are we going to do?
Add back.
We are going to add back. So we look at excess depreciation. Where is our profit? Where can we find our profit? Is it at the beginning or at the end?
At the beginning.
No.
At the end.
The profit is 6,000 for the year, isn't it?
Mm-hmm.
So where is our 6,000? Our 6,000 is in the reporting. So the profit will always be in reporting. So we come and add the 500 back, which is the excess depreciation. Let's move on. So let's come to, let me come to the figure that I was using first. Let me come to the figure that I was using first. Okay. Let me come to the figure I was using first. So I use 5,000 and what? 3,000, isn't it? And the depreciation we got for this one was 1,250 and this was 750. Okay. Okay. So in actual sense, what should have been the depreciation that should have been subtracted from the PP to get a carrying value? What should have been the depreciation that's supposed to be subtracted to get a carrying value? It should have been 750, isn't it?
Yeah.
All right. Let me take that side again. It's not easy. Okay. What do we do to the PPE? We subtracted what? 2,000 to bring the value now to what? 3,000, isn't it? Assuming it was 5,000. Was that not what we did?
Yes.
Okay. But initially it was 5,000 and they are subtracting a depreciation of what? 1,250, isn't it?
Mm-hmm.
But if we are now having 7,000, if you are now having 3,000, what should have been the depreciation that we should subtract? 750, isn't it?
Mm-hmm.
It means that they are still subtracting because we didn't adjust the accumulated depreciation subtracted from the figure. We only adjust the cost, which is the 5,000 to 3,000. And the depreciation has been subtracted before we got the 5,000. So what are we going to do? It means that they are subtracting 1,250 from the as depreciation from the PP. It should have been 750. So what we are going to do is that we are going to bring back the 1,250 to 750. So in this case, what we normally do is that after subtracting the fair value down, you go and add back the depreciation, the excess depreciation, to bring the 1,250 to the actual depreciation, which is 750. So you count your PP, then you add your excess depreciation to it. You add your excess depreciation to it. Or another way of doing this is that, if you are having 5,000, what should have been the carrying value? 1,250. That is the actual depreciation. This should have been 3,750. If you are using 3,000, depreciation should have been 750. And your carrying value should have been 2,250. It means that in the PPE, you are having the asset as 3,750, which should have been 2,250. It means that you are overpricing the asset by 1,005. So what you do is that you are going to subtract the 1,005 from the PPE, which is the same as you having the 2,000 plus 500. 2,000 is negative. Negative 2,000 plus 500 is minus 1,500. They are all the same. Anyhow you do it, they are all the same. Let's move on. Ibrahim,
Yes, please.
I hope you have done FR before.
Yes.
Okay, you can see that you are learning new things, isn't it? Don't worry.
Mm-hmm.
Be very fine.
We shall be well.
It is war. It is already war. So we are done. What I'm going to tell you is that if the fair value has increased also, it is going to bring additional depreciation. So the only thing is, okay, if the fair value has increased by 2 million, it means that they didn't charge the depreciation on the 2 million because they are not aware of the 2 million. So just charge the depreciation that you should have charged if the 2 million exists. Then you charge the depreciation on the 2 million, you go and subtract it from your net asset as reporting. If there's a reduction, it means that they have charged the depreciation on the 2 million because they are not aware of the 2 million reduction. So they have included 2 million in the cost before charging the depreciation. So there's a depreciation in the profit and loss account relating to the 2 million reduction. What is that depreciation? Let's charge the depreciation on the 2 million using the remaining useful life of the assets before the fair value. Then that one we go and add it back because it was subtracted. We go and add it back. That is what we normally do. That is basically what we do. The next one is what? Kafi, are you there?
Yes,
Okay.
sir. The fair value of Stretcher's investment was 7 million. He also notified Stretcher owned
No. Let's
right.
look at that one first. The fair value of the Stretcher's investment was 7 million, isn't it?
Yes.
They are talking about a financial asset. What is the value of their financial asset? Stretcher. Financial asset.
6,000.
6,000. But now they are saying is what?
7 million.
7 million. So it means that it has increased by what?
1 million.
It has increased by 1 million, which is 1,000. We are keeping 3 zeros, isn't it?
Yes.
Yeah.
What will be the effect of this on the net asset? Is it going to increase it or reduce it?
Increase.
It will increase. So what we are going to do is that we now come here and make our financial asset to be what? We add what? 1,000 back, isn't it? To make it a 7,000 now, isn't it?
Yes.
Then we go to our, this one, we have financial assets. It will increase our asset. Therefore, it will also increase the net asset. We add 1,000 back. We add 1,000 back. Are we okay? Let's move on. What's next? Let's move on. What's next?
Stretcher owned the rights to a popular mobile cell phone game. At the date of acquisition,
Okay.
a specialist valuer estimated that the rights were worth 12 million and had an estimated remaining life of 5 years.
Okay. In the financial statement, do you see anything concerning mobile phone for
No.
Stretcher?
No.
No. Since the parent is buying this, they need to recognize it. So this will now be a new asset to them. Have they recognized it in the books? Have they recognized this in the books? If you see the statement of financial position, do you have any mobile phone there?
No.
Do you have any intangible asset there? No. So
No.
if this was not in the book and this, we are now coming to recognize this, what will be the effect of this on the assets? Is it going to increase the asset or reduce the assets?
It will increase.
Yes.
It will increase the asset.
Yes.
Therefore, the net asset will also what? Therefore, the net asset will also what?
Increase.
Increase or reduce?
Increase.
Increase. So if you want to know the net asset, this is what you are going to do. If the thing is going to reduce the asset, it means that the net asset will also reduce. If the asset is reducing, you are subtracting liability, it means that your capital will also reduce. So at the date of acquisition, we have 12,000. At the date of reporting, we have what? 12,000. So in the statement of financial position, we now go and recognize what? Mobile phone. Mobile phone. Mobile phone. What is the initial value? 12,000, isn't it? All right. But what did they say again? What did they say again? They said what? Had an estimated remaining life of what?
5 years.
5 years. It means that at January, the value was 12 million, isn't it?
Yeah.
At June, would the value be 12 million again?
So please, I have a question. Sorry.
Okay.
Is it the right we are going to recognize as intangible asset or the mobile phone?
I don't want to make it intangible because we are
Okay.
going to have goodwill also. That is why I make it the mobile phone.
Okay.
Are you okay? I don't want,
Yeah.
if I make it intangible, you see that goodwill also will be there. Then you ask me, why didn't I add a goodwill to the intangible? That's why I make it mobile phone.
Okay.
Are you okay? So that it will not be confusing. I can make it the intangible because I have goodwill. Good is also intangible. Are you okay? Or you can also say the right to mobile phone. Right to mobile phone. Anyhow you do it. Are you okay? All right.
Yeah. Okay. Thank you.
So the right is what? 12 million at the date of what? Acquisition. And they say this has a remaining useful life of what? 5 years. So at the date of acquisition was January 2015. By reporting, when we are preparing this is what? At reporting date, which is what? June 2015. So the value was 12 million at the beginning. At the end, would the value still be 12 million?
No. No.
January was 12 million. June, would it still be 12 million?
No.
No.
What will happen?
The value will reduce.
The
So
value will reduce because we have used 6 months already, isn't it?
Yeah.
All right. So what will be the
yes.
amortization for that 6 months?
1,200.
What will be the amortization for that 6 months? $12 million over 5 times what? 0.5, isn't it?
Yeah.
So what will be the value?
1,200.
Yeah.
So that 1,200, what should have been the effect of that on our profits?
It will
So
reduce
this is
it.
supposed to be minus 1,200,
Decrease.
isn't it?
Yeah.
All right. So the new value will now be
Yes.
10,800. So what will be the effect of that on our profits? If we should have recognized the mobile phone from the reporting, it means that this amortization will be charged against our profit or loss account, isn't it?
Yeah.
But have we done that?
Yes.
Have you recognized the mobile
No.
phone first?
No. Yes.
No, it means that this should have reduced our what? Profit, isn't it? So
Yeah.
we come here, we look at amortization
Yes.
of, it means that if we should have recognized this amortization first, it will reduce our profit. Where can we see profit? Is it at
The
reporting or at acquisition?
reporting.
So we subtract 1,200, which is the
Reporting.
amortization we should have subtracted from the profit, but we didn't recognize the rights. So we have to go and do that now. All right. So what will happen is that our value will now be 10,800 for mobile phone because we have used 6 months out of it. Okay, let's move on to the next one. Okay, let's read through and see whether we don't have any other things to do for the net asset table now. Following the impairment review, consolidated goodwill is to be written down by this. No problem. Polyester source goes to this. Polyester is the one selling. At the date of June, the fair value of the financial equity investment of Polyester and Stretcher were this and this. We come. Polyster's policy is to value the non-controlling interest at a fair value at the date of acquisition. For this purpose, Stretcher's share price at that date is representative of the fair value of the shares held by the non-controlling interest. The question that we solved the last time was non-controlling interest at proportionate share of the net asset at acquisition. So we don't have anything to do with the net asset again. Let's total them. Let me total the net assets, which is some. Okay. So what is the net asset at acquisition? Net asset as acquisition is what?
54,300 minus the 49,000.
That is, I'm talking about net asset at acquisition is 49,000. At reporting is what? 54,000. The difference is what? The difference is what?
5,300.
So the difference is the profit for the year, is the post-acquisition profit for the year, which we are going to share among the NCI and then the parent. So the difference between the reporting and then the acquisition is the profit for the year. Okay. So what are they saying? They are saying that it is a policy of the parent to value the non-controlling interest at a fair value at the date of what acquisition. For this purpose, the Stretcher share price at that date is the representative of the share price of the non-controlling interest. What is the share price value of the Stretcher? What is their share price? What is the share price of the Stretcher? It's 3 cedis, isn't it?
Yeah.
What is the value of the shares? What is the number of shares owned by the NCI?
75%.
What is the?
No, 25%.
I'm talking about the shares, not the percentage. What is the total number of shares bought by the parents? It's not 15 million.
Yes.
And the total value for the subsidiary is 20 million. So what portion is relating to the NCI?
5,000.
So 5,000 multiplied by what will give us their value? 5,000 times what will give us their value? So fair value of the NCI will be their number of shares multiplied by the share price. That will be the one share is 3 cedis. So number of shares is 5,000 shares times the 3 cedi. Times the 3 cedi. How much is that?
15,000.
15,000. Okay. Assuming we are using the proportionate share, where we are going to find the 25% of the net asset at acquisition, what should have been the value of the NCI? What should have been the value of the NCI? What should have been the value of the NCI? 25% of what 9,000 is what? What are we getting? 25% of what's 9,000. What are we getting?
Please, I'm lost.
I'm saying that if we are using proportional share, it means that we are going to find 25% of what the 49,000, isn't it?
Yes, please.
But we are now using fair value, which is
Yes.
15,000. So I'm asking that just try the proportional share. Let me see something, or let me explain something to you. It's not that we are. It's not.
That
We
would
are
be
using proportional share.
12,250.
That would be 12,000.
250.
But what value are we recognizing?
15,000.
What is the difference?
2,750.
2,000.
750.
That 2,000 represent the share of the goodwill relating to the non-controlling interest. That is the reason why, if you're using fair value method, the impairment is shared among the parents and the NCI. Because the NCI should have gotten 12,250, but they are now getting 15,000. It means that they are also taking part of the share of the goodwill, which is 27,000, which is 2,750. That is why, if you're using the fair value method, we are pushing the impairment of the goodwill to the NCI also. Are you okay?
Yeah.
All right. Let's move on. So what will happen? What will increase their own is the share of the post-acquisition profit, isn't it? Share of post-acquisition profits. The post-acquisition profit is how much? So we have 0.25 times what? 5,300. Am I correct?
Yes.
Okay. So what will be their share? What will be their share?
1325.
1325. Okay. So we learned that there was impairment of goodwill, isn't it? There was impairment of goodwill in the question. There was impairment of goodwill. So the NCI will take their portion, which is 0.25 times the impairment figure, which was 3,000. So NCI will be taking how much? The impairment is how much?
750.
750. Is it going to be an addition or reduction?
Reduction.
So we put it in brackets, share of impairment. All right. So if you don't want to do anything, come and count to the parents' return earnings. The parent return earnings will start with their own balance. The parent is also doing some activities on their own. So they are also going to generate profit for the year. So we take their profits, total profits, then we add the share and other things that are relating to the subsidiary. What was the parent's profit at the start of the year?
26,000.
And what is the profit?
26,200.
What is their profit for the year?
26,200.
That is at the starting, isn't it?
Yes.
And their profit for the year is how much?
24,000.
So what will be their total return earnings?
3,200.
50,200.
5,200. So you bring it here. Then we now start doing our thing. Share of post-acquisition profit, isn't it? The parent will take part, which is 25% of that. If you like, you can just find the difference. 5,300 minus 1325. It is 39.75. Okay. The parent will take the share of the impairment loss. Share of the impairment loss. Share of the impairment loss. If you like, just find the difference and bring it here. It was 3,000 minus 750. That would be 2,250. Is it a reduction or an addition?
Reduction.
2,250. Are we okay? All right. Let's move on again. Let's move on again before we deal with the items one by one. Okay. So we are done with the impairment loss. We are also done with what? Okay, let me calculate the goodwill for you. What is the net asset at acquisition?
49,000.
That is the total value of the company, isn't it?
Yeah.
What is the portion of that relating to the NCI? What is the portion of that relating to the NCI?
Is the percentage of the NCI times
No. We are using fair value of the NCI.
15,000.
So 15,000
Okay.
out of the 49,000 relates to the NCI. Are you okay? We can
Sure,
only
sure.
do that if you are using proportionate method. But if you're
Okay.
using fair value of the NCI, it means that the 49,000, which is the total value of the subsidiary, 15,000 out of it relate to the NCI. So what will be the remaining figure?
$34,000.
That will be 34,000. So it means that the parent is buying what? 34 what?
34,000.
Thousand. How much are we paying for it? So okay, let me do this. Let me bring this one down so that I will add the two and have the total consideration paid here. So how much do you pay?
42,000.
How much should you have paid before? 34,000, isn't it?
Yes.
Okay. Another way of doing this is that just add the NCI to this one. Then you subtract the total 49,000 from it. So you add 42,000 to 15,000. Then you subtract the total 49,000 from it. You are going to get the same thing at the end. So what is the goodwill at acquisition? This is the goodwill at the date of acquisition. At acquisition is how much?
8,000.
Use the one that you are comfortable with. Me, I like using this one. Okay. But they say the goodwill has impaired by how much?
3,000.
The goodwill has impaired by 3,000. So the impairment is what? 3,000. Is it addition or subtraction?
Subtraction.
Okay. So if the goodwill has impaired by 3,000, what will be the goodwill at reporting now?
5,000.
I'm coming in. The goodwill at reporting will now be what? 5,000, isn't it? So goodwill at reporting is now 5,000. So in the statement of financial position, we are going to put goodwill there at 5,000. So we have goodwill here. 5,000. Then you tell us the workings. What is the workings for goodwill? Workings 3. Then you put it in your listing workings 3. Goodwill. Then you put the 5,000 in here. Are we okay? All right. Let's move on to another thing. Following the impairment of goodwill, we are done with the foot. Let's count to footnotes. We are done with everything now. Okay. Let me let me deal with the oh Charlie. Let me finish everything before I will do that. Ato.
Okay.
Okay, let me finish everything before I will do that.
Okay.
Okay. All right. So the 4, I'm not touching the 4 because the 4, it is the parent that is selling. So the maybe unrealized profit and those things will be affecting the parents. That is why I didn't touch on that one. But we have touched on the following the impairment review. We have touched on that. We have done the Polystar policies too. We have done that too. Let's count to the distance, the 4 before we move on to the. Let's count to the 5 before we move on to the 4. So Kafi, are you there? Read for us.
At 30th June 2015, the fair values of the financial asset equity investments of Polystar and Stretcher were 13.2 million and 7.9 million respectively.
So what is the portion relating to the Polystar and what is the portion relating to Stretcher?
Polyester is 13.2 million and
Which is
Stretcher is
13,200, isn't it?
Yes.
All right. So ask yourself, what was the value of the Polystar's financial assets? What is the value now? What is the value in the statement of financial position?
11,000.
So what is happening?
Reduction.
Is it a reduction or increase?
Reduction.
Increase.
It's an increase by how much?
Please, the footnote again, I did not hear.
Okay. At 30th June 2015, the fair value of the financial equity investment of Polystar and Stretcher were 13.2 million, which is 13,200, and 7.9 million, which is 7,900 respectively. So what I'm asking for Polystar, what is their value of the equity investment in their statement of financial position? That was 11.5, isn't it? 11,500. But they are now saying it is how much? 13,200, isn't it?
Yeah.
So I'm asking, was there an increase or decrease in value?
Increase.
Increase by how much? The increment is how much? If people don't have calculators, I have plenty.
Oh, 1,700. I said it.
1,700, isn't it? So this
Yes.
1,700, what are we going to do with it? We are going to increase the financial asset equity investment now to 13,200, isn't it?
Yes.
Yeah.
So we go and add the 1,700 to it. But the 1,700, is it a gain to the parents or is a loss? Is it a gain or loss?
It's a gain.
It's a gain. And where would that gain go? Is it return earnings or what?
Return.
No, it will not be return earnings.
Surplus.
It will go to other components of equity. If the parent is not keeping other components of equity, then you take it to return earnings.
Oh, okay.
The only items that go to return earnings is the income from our ordinary business activities. This financial assets is not something that we do. We are not investment company that we buy shares in other companies. No. So that particular gain will count to other components of equity. What is the other component of equity balance? It was 4,000, isn't it?
4,000.
So this will now increase by 1,700. So let's count to other components of equity. What is the figure? Okay, we have the balance here. Balance at the beginning is 4,000. So we now add the gain, fair value gain, or fair value gain, which is what? 1,700. Are we okay? All right. Let's count to Stretcher. Okay. Stretcher own is what? 7,000 what? 900. Are we there? Okay. But what was the value in the statement of financial position?
6 million.
6,000, isn't it?
Nil.
At the date of acquisition, do we do something to the investment? At the date of acquisition, the investment increased by what? 1,000, isn't it?
Yeah.
The fair value of the stretcher's investment was 7,000. So it means that at the date of acquisition, we have already increased the investment by 1,000 already. So their value now is 7,000. That is where, if you see the investment, we have added 1,000 to it. So we have increased the stretcher's investment to 7,000 now. But they are saying that at the end of the year, it is now what? 7,900. What is happening? It has increased by how much?
900.
900. So this 900 is a gain, isn't it? Which is for stretcher.
Yes.
Who are the owners of stretcher?
The group.
It is the parents and then the what?
NCI.
The NCI. So that particular gain will be shared among the NCI and then the parent. But the parent is keeping other components of equity. So you take the parent share to the other component of equity. So share of post acquisition gain, fair value gain. Let me just put it like that, which will be 0.75 times 900. Am I correct?
Yeah.
Okay.
900.
What will be the value? 0.75 times 900 is what? It's how much?
675.
675. So what will be the NCS share?
And
275.
NCS share will be what? NCS share will be 25% of that. Just subtract the parent share from the 900. That will be 225. That is the NCS share. But if the parent is not keeping the other component of equity or revaluation reserve, then we send the parent shares to what? To the retained earnings. And in that case, that particular gain will form part of the net asset table. We come and add the 900 to the reporting figure. Are we okay? All right. Let's take the last part. Let's take the last part, which is the I4. All right. Which is the IV. Help us.
Pallister sells goods to stretcher at cost plus 30%.
Okay.
Stretcher had 1.8 million of goods in its inventory at 30th June 2015, which had been supplied by Pallister.
Okay, it means that 1.8 of the goods supplied by what? By Pallister to stretcher were not sold, isn't it?
Yes.
But the 30%, is it a markup or margin?
Markup.
Okay. You see, sometimes the question can also put it like this. Supply at 1.8, then they'll put it in the bracket, cost to stretcher. You know that the cost to stretcher is the selling price for Pallister, isn't it? Do you agree with that? A cost to stretcher is a selling price to Pallister.
Yes.
Okay.
Yes.
So they can put that like that. You have to be able to interpret it. But this one, the 1.8 is the worth of goods to the stretcher. So his stretcher is having these goods at a selling price. So what do we do then? What do we do then? We have to change the markup to what? Margin. So how do we do that? So working 7, provision for unrealized profit. So how do we do that? So this would have been 3. That would have been 3/10 if we change it to percentage, isn't it? If you change it to fraction, it will be 3/10, isn't it?
Yes.
All right. If you are changing markup to margin, margin must always be lower than a markup. So add the numerator to the denominator. So that would be 3/13. But if you are changing margin to markup, subtract the numerator from the denominator. So this will now be 3 over 13. 3, it will be into brackets. Okay, it will be into brackets 3 over 13 multiplied by the what? The value of the goods, isn't it? Which is 1,800, 1.8 million. What will be the figure? To the nearest whole number. I'm getting decimals. So let's make it to the nearest whole number. What will be the figure?
415.
415. It means that this portion of the profit was not realized by the what? By the parent, isn't it?
Yes.
Is that the meaning?
Yes.
Yes.
So what do we do? What do we do with this one? We go and subtract it from the retained earnings of the parent, isn't it?
Inventory. Yeah.
Okay, so the time that the parent was selling these goods, they assume that the stretcher is going to sell all. So they have realized all the profits. But here is the case, all the goods were not sold. The stretcher will also be carrying these goods at what? 1.8, isn't it? Which is the selling price. Inventory should not be carried at selling price, or inventory should be carried at lower of cost and eat what? Net realizable value. So we count to inventories, which is current asset. We count to inventories. Hey, I didn't put the inventories here. Hey, assemble. So we have the inventory. Mention the inventory figure for me again. 17,400 plus what?
15,400.
Plus 15.
400.
Okay. So what will happen is that we are going to reduce 17,000 plus 15,400. Okay, so we are coming to reduce it to the cost price now. So we do minus 1,415. That is the effect. Let's read on. Let's read on. We have eliminated the first part. Let's read on. Let's read on. The next one is what? The next one is what?
Polyester proceeds.
In addition,
on 28th June 2015, Polyester processed the sale of 800,000 of goods to Stretcher, which Stretcher did not account for until their receipt on 2nd July 2015.
okay.
The in-transit reconciliation should be achieved by assuming the transaction had been recorded in the books of Stretcher before the year end.
Okay. So what they are saying is that, let's take that part first. What they are saying is that in addition to the first intergroup trading, which is the selling of the 1.8 million, in addition to that, on 28th June, Polyester processed the sale of what? 800,000 goods to Stretcher again, which Stretcher did not account for it until the receipt on what? July 2015. They are saying that we should assume that the goods has been received by what? By Stretcher before the year end, isn't it? So if the time that the parent is processing these goods, the parent is assuming that all the goods will be sold and they are realizing the profit on it, isn't it? But here is the case, all the goods were not sold. So it means that the profit on the goods will not be realized, isn't it? And these goods will still be sold at the 30% plus cost. So what will happen is that, okay, we should assume that the Stretcher has received these goods. But if Stretcher has received these goods, none of these goods were sold. So the profit element on the goods will not be realized. So let's find the profit element first before we know what to do. Let's find the profit element. The profit element will still be, let's look at the provision for unrealized profits, which is the second one. That will also be the profit element will still be the 3/13 into bracket 3/13 times what? This place will now be 0.8, isn't it? Which is 800. Am I correct?
Yeah.
All the goods will not be sold. What will be the unrealized profit? The nearest city.
$184.
The nearest city, 185. Okay. So it means that this profit is still contained in the parent what? This one, we go and subtract the 185. Because all the goods were not sold, we take the 185 from it. All right. So the question is saying that we should assume that the goods has been received by what? Stretcher, isn't it?
Yeah.
If the goods has been received by stretcher, what will happen? If the goods should have been received by stretcher, what will happen? Stretcher is going to receive inventory, isn't it?
Yeah.
The inventory will be how much? How much are they going to receive? They will receive 800, isn't it?
Yes.
They are here to pay for the goods. So they will have payables, which is liabilities. Am I correct? They haven't paid for the goods, so they will increase their liability. So they will debit their inventory and credit liabilities. Am I okay there? That is what is going to happen. But the 800 as inventory, is it a selling price or cost price?
Selling price.
So what do we have to do? We go and take the unrealized profit from it, which is 180 what?
5.
Okay, let's come. Read the additional one again. Read the additional part.
In addition, on 28 June 2015, Polyester processed the sale of 800,000 of goods to Stretcher, which Stretcher did not account for until their receipt on 2nd July 2015. The in-transit reconciliation should be achieved by assuming the transaction had been recorded in the books of Stretcher before the year end. At 30th June 2015, Polyester had a trade receivable balance of 2.4 million due from Stretcher, which differed to the equivalent balance in Stretcher's book due to the sale made on 28th June 2015.
Okay, so it means that the difference between the trade receivable balance of Polyester to the trade payables of Stretcher was as a result of the 800, isn't it?
Yeah.
So it means that in the trade payables of Stretcher, they are having 1,600 as payables to Polyester, isn't it? But they say
Yes.
we should assume that we have done that already. So you can see that for the current liabilities, we have added the 800 to now make it 2.4, isn't it?
Yes.
So what are we going to do? They cannot be owing each other. So what we do, we cancel it, isn't it? So we count to
Yes.
the current liabilities, we do minus 2,400. We go to receivables also. We do minus what? 2,400. You can't be owing each other. Okay. Let me also show you another way of doing this. Another way of doing this without adding the 800 to the payables is that just come and subtract the 2,400. That is the 2,400 in the receivable. The receivable is 2,400. But if we didn't add the 800 to the current liabilities, how much would have been a value in the current liabilities? It should have been 1,600, isn't it?
Yes.
Look at this, 800 minus 2,400. What is the difference? $800 minus 2,400. What is the difference? It's not 1,600.
Yeah.
So the only thing is just subtract the figures that are here. Okay, they have 1,600 relating to this. Come and subtract the 1,600. Go and subtract the 2,400. What is happening is that the difference will go to the inventories. You can see that they are receiving the inventories. So since the trade receivables is reducing by 2,400, inventories is receiving 800. So in under normal circumstance, assets is reducing by 1,600. and the liability is also reducing by 1,600. At the end of the day, they are all getting the same figure. So let's total and see. We are done. Let's total this one and see. This will be 44,000. Let's go and add everything, and we come and close our this one now. So what will be the value for? So let me find the group return NS here. Okay, group return is 5,400. So I will just take the 5,400 and go and put it there. 5425. So group return NS is 5425. That is workings 5. So you put it into the brackets workings 5. 5425. Other components of equity is, so this is the other component of equity. It's 6375. Other component of equity is 6375. 6375. Okay, let's find the non-controlling interest, which is workings 4. Non-controlling interest is, let's move on to the non-controlling interest. So non-controlling interest will give us a sum. So non-controlling interest is 15,800. So let's go and put it there. 15,800. So the total now will be this plus this. That will give you now. Okay. Let's close the other ones. We have the goodwill already. We have the group structure. I'm sure that all the workings that we have closed them. Okay, let's come to the addition of the rest now. The actual figures. Let's do the liability. 25,800 plus 18,100 minus 1,600. What are we getting? What are we getting?
What is 7,100? 7,100.
No. 25,800 plus 18,100 minus 1,600. Do it again. What did you get? I'm getting
42,300.
42,300. Okay. So we can now total our liabilities in the equity now. So we have Let's go to the asset side. What will be the value of the bank? The bank will be 4,000. What of the trade receivables? 14,300 plus 10,500 minus 2,400. 22,400. Someone should be confirming. 17,000 plus 15,400 minus 415 plus 800 minus 185. 32,600. Is it correct? Okay. Goodwill is 5,000. Let's come to our financial assets. 11,500 plus 6,000 plus 1,000 plus 1,700 plus 900. 21,100. Let's come to our PPE. 55,000 plus 28,600 minus 2,000 plus 500. We have 82,100. So let's total and see. So this. Where is the 800 coming from? There's a difference of 200. Where is the 200 coming from? Can someone mention the figures one by one for me? 25,800. Liabilities is 25,800. 25,800. Okay, let's look at this one. It's 600. 28,600. 666. Seventeen thousand. 17,000 plus 4,000. Okay. There is one, this is 14,000. Okay, the bank. Can you see the bank figure? The bank was what?
2,200.
200. But what figure did you put there?
1,400.
Okay.
2,100.
So this should have been, so 2,000, 2,200 plus 1,600. Supposed to be 3,800. All right. All right. Ladies and gentlemen, this is all about what we are doing. Ato, I cannot explain this thing to you, the consideration to you now, isn't it?
Yeah.
Okay. But apart from the consideration, you are okay.
Sure.
The questions
Doris,
are
unless I go through the questions and the workings, I understand.
okay. The questions are 42. I will solve only 5 out of them. It means that the
Okay.
remaining 37 are for you people. All right. So let's read from the beginning. They say that on January 1, 2015, Pallister acquired 75% of the the Stretchers equity shares by means of an immediate share exchange of 2 shares in Pallister for 5 shares in Stretcher. So, okay, we are buying 75% of the shares of Stretcher. So the question is, what was the total value of the shares in issue by Stretcher? Their value of the shares is 20 million. We are keeping 3 zeros at the top. And 1 share is 1 CD. It means that the number of shares is also 20 million shares, isn't it?
Yes, please.
But we are buying 75%. So 75% of the 20 million will give us how much?
Times 20 million.
75% of the 20 million will give us what?
1.5 million.
Okay, which is no, it's 15 million.
1,500. 1,500.
Are you sure? 20 million is supposed to be 15 million. 0.75 times 20 million
Sure.
is 15, isn't it?
Yes, please.
Okay, that is the shares that we are buying. But we are telling them that they should bring 5 of their old shares for 2 new in our company. We don't have money to pay them. So bring 5 of
Okay.
their old shares for 2 new in our company. The easiest way to do that, to find the number of shares that we are going to give them, is to take the 2 over the 5 times the number of shares that we are buying.
Okay.
So that would be 2 over 5 times 15. What are you getting?
6.
So it means that we are giving them 6 million shares, isn't it?
Yes,
The
please.
6 million shares is the shares of the parent that they are giving to the subsidiary shareholders. So it means that these shares will be valued at the parent shares price at the date of the acquisition. So you can say the fair value of the Pallister and Stretcher shares on January 15 were 4 million and 3 million respectively.
Okay.
So the share price of the parent is what?
4 CDs.
Which is 4 cities. So the 4
Yeah.
cities, they're going to use it to multiply the 6 million shares that they are giving to them, because the shares are for the parents and they have to use a parent share price to multiply them. So 4 times 6 will give us a 24 million.
Yes, please.
That was how come we got the share exchange to be 24,000.
24,000.
All right.
Oh, okay. Okay.
Let's come to the deferred consideration.
Okay.
Deferred consideration, the question is
So
saying that, okay,
I'm coming on. So for the first one, for the consideration is the number of shares that the parents are trading for the subsidiary. Then
yes,
times the equity, how do they call it? The share in issue. Then times their percentage, right?
yes, the shares that you are buying, we are not,
Sure.
the shares are 20 million, but we are not
Sure.
buying all the 20 million, so we can't issue the shares to all the 20 million.
Yeah.
So it's the portion that we are buying that we are going to accept them to become the owners of our company. So find your portion, 0.75 times the number of shares in issue by the subsidiary. If you get that one, then you now use your proportion, the proportion that you are issuing the shares to them. 2 shares in Pallister for 5. It can be 3 for 5. You just do your 3/5
Sure.
times the number of shares that you bought. Then after getting that value, that is the number of shares that you are going to
Yeah.
get. Then you value that particular share using the
Then
parent
times the okay.
parent share price. Are you okay with that side?
Okay.
Okay. The next one is in
Yeah.
addition to the share
Yes,
exchange.
please.
In addition to the share exchange, it means that the consideration is not only settled by share exchange. In addition to the share exchange, Hollister will make a cash payment of 1.32 per acquired shares. How many shares are they buying?
50 million.
So it means that one share is 1.32. They are going to pay 1.32 for every share. So if you
Yes,
multiply
please.
by the 15 million, what are you getting?
1.2. 19,800.
19,800. Okay.
Yes, please.
Deferred until January 2016. That means the money will be paid in how many years' time?
This is accounting year. 1 year time.
It will be paid in
No.
1 year time, isn't it?
Yes,
But we are
please.
not going
Yeah.
to do the consolidation in 1 year's time. We are doing the consolidation as at January 1. We want to know the amount that we are paying for them. If we shouldn't have deferred that particular amount to 1 year's time, how much should you have paid? So that 19,200, we present value it.
Okay.
We present value it. How do we present value it? The 19,800 is the future value in 1 year's time. So for you to find a present value is equal to the future value divided by 1 plus R or exponent n. The R over there is the cost of capital of the parents. So
Okay.
what you are going to do is that your present value will now be your present value, which is the value that you should have paid today, is the future value divided by 1 plus R or exponent n. The n is the number of years that you are going to pay the money. So in this
Okay.
case, the present value will now be, present value is equal to 19,800. That is the money that we are paying in future, divided by 1 plus 0.1, which is the cost of capital for the parent. The exponent will be 1, so you don't have to do anything.
Okay.
So your present value will now be, present value is equal to 19,800 divided by 1.1. What are you getting?
18,000.
That is how come we got 18,000 for the deferred consideration.
Oh, okay.
So you can see that we have the fair consideration, which is what? 18,000.
18,000. Oh, okay.
It means that as at today, the parent is owing the shareholders of the subsidiary 18,000, isn't it? But they are
Yes,
going to
please.
pay 19,800 in a year time. It means that they are paying interest of what? 1,800. Because the total amount that they are going to pay is 19,800, but the amount that they should pay today is 18,000. So the difference is the interest that you are going to pay on the money. Someone's money is with you. If you should have given them the 18,000 today, maybe they can invest it and get interest on it. Since you are holding it, you have to pay the interest to them. So it means that they are going to pay interest of 1,008 for a year. But we are doing the account for 6 months. So we divide the interest by 2, we get 900. So it means that as at the 10th June, the parent will now be owing them the 18,000, which is the initial value plus the interest, which is 18,900. That is how can we have the liabilities of the fair consideration to be 18,900 in this place. You can see that we have the consideration to be 18,900. As at the date of acquisition, you are owing them 18,000 because you are going to pay them this money in the future. So you are owing them. But you haven't paid the money, you are paying interest of 900. So if you want to pay, it will be the interest plus the amount that you are owing them. That is how come we have the 19,000, the 18,900 there.
Okay.
And that will be a cost to the parents. The interest for 6 months will be a cost to the parents. And that was why we have finance cost. You can make it interest, the finance cost. That's why we have the 900 as expense that the parent is going to incur, which is the interest that they are paying. Are you okay?
Yes, please.
Right. So basically, that is all about this one. What I'm trying to do is that by the end of this month, we should be able to finish everything about consolidation and be doing standards in the evening and then also in the morning, so that we can finish with most of the standards before we do the final accounts. The final account, there is no anything. It's basically based on the standards. So if you know the standard, at least we should be able to do 10 standards. So by the end of this month, we should be able to finish the consolidation. So next week, by this time, we solve 2 questions on statement of profit or loss. 2 questions. Then we come and do a full one, like a question that you solve the statement of financial position, and they will still give you a statement of profit or loss. They can give you that in exam. They'll give you the 2 statements that you should prepare. So
Please, have you reached associate?
Is it?
Have you reached associate yet?
I've done associate last week. That was the last question. That was last sitting question. We solved the last sitting question and we have issue about associates. So we have done that. But you still, if we can pick a question, which is statement of profit or loss, that we are going to have issues about associates, we pick a question and we look at how to deal with them when you are doing statement of profit or loss.
Okay.
But for statement of financial position, we have done that for the last sitting question. All right. So, ladies and gentlemen, if there's no further question,
please let me with the unrealized profits and the net assets schedule.
Yeah.
So if it's like the parent is selling to the subsidiary, it means there's nothing, I mean, relating the unrealized profit to the net asset.
Yes, because so that will affect the parent. The profit is the parent that is getting the profits,
not the subsidiary.
Not the subsidiary. But if the subsidiary is selling, it means that the subsidiary has recognized that portion of the profit which is not yet in its profit. And the profit will be found in the net assets.
Okay.
All right. So if there's no further question, ladies and gentlemen, my name is Linus, but people call me Brain. So Charlie, I will see you people in the evening.
Thank you.
All right.